Hi guys, this is Siddhant from VIJAY and we'll be discussing in this lecture about fundamental analysis and why is it important. So getting started with it, the first thing that we need to keep in mind is that fundamental analysis is used for investing for a longer period of time, and the analysis that we get after doing fundamental analysis is usually for a longer period of time. That will be particularly starting from 2 years, 1 year plus, from 2 years to 5 years, and can go up to 5 or 10 years also. So fundamental analysis majorly involves understanding the business model of any business that you want to understand, or any company that you want to start analyzing. You first have to understand the business model of the company, that whether you think that the business model of the company is good or not, whether it has a future or not. For example, if you check out Elon Musk and if you check out the inflow of the electric cars, we are pretty damn sure that if not now, in the next 5 years, in the next 10 years, the world will be changed and it will be only electric cars. So that is why we can even see that because of electric cars, the components that are put in electric cars, for example, lithium ion batteries are involved in electric cars. So the demand for obviously the Tesla cars and electric cars will rise, but with that the demand for lithium ion batteries will also rise massively. That is why right now we've seen a lot of surge in the prices of the stocks which are in manufacturing of lithium ion. Plus China has also started developing and manufacturing a lot of lithium ion batteries because they know that it's the future. Plus Panasonic also had recently set up a plant for Tesla, only to manufacture batteries which will be used in the production and the usage of Tesla cars. So that is why we need to understand the business model thoroughly before we are investing any company. Secondly, we'll have to go on and we should be able to understand and explain the business model within 60 to 90 seconds. If it is too complicated, I think it's going to be very tough for you to understand, and rather you should be clearly able to explain the business model and how the company is making money within 60 seconds so that you can sell it. And anyone should be able to buy you on it, that the reason why you've invested is clearly tuck, you've got 5 points and you know clearly that these are the reasons why I'm investing. So fundamental analysis involves reading the balance sheet. So from the balance sheet you will particularly get to know what are the assets, what are the liabilities, and how are they moving on, and how, if you check out the balance sheets year on year, you'll be able to see what is the growth that the company is getting in asset base and in the infrastructure, and how the company is growing. So balance sheet tells you details about the company on a particular day, on particularly the last day or the ending day of the financial year. So that is what is balance sheet. So when we'll be making a video next, we'll be telling you about how to read the balance sheet, and we'll be having a practical balance sheet of a company which is trading on the stock exchanges in front of us, and we'll be analyzing that. So other than that, profits are made and seen on the profit and loss statement of the company. So P&L account is extremely important to understand what are the sales, what are the expenses of the companies, what tax the company is paying, what is the interest cost on the finances that the company has taken or the debt the company has taken from other different sources. And other than that, it will tell you all good details about the operating profit margins that the company is making and what extraordinary gains that the company is making. So P&L is another excellent and important factor. Then thirdly, we come on to cash flows. Cash flows are of 3 types, particularly operating, financing, and investing. So operating is what money the company is getting in from all the operating activities that it is doing. The investing activities where the company is investing its money in order to expand and grow. And financing activities is particularly from where the company is raising more finances in order to invest, or where is the company getting it finance from. So that is what cash flow tells us. Particularly fundamental analysis helps you tell that where one should invest. It is not when one should invest, it is where one should invest and which company you should invest in. The price at which you need to get in will somewhat, fundamental analysis will give you a chalk line, but technical analysis will help you out in understanding the exact entry point. So There is another parameter that you need to see. There are two kinds of approaches in fundamental analysis. That is, one is economy, industry and company. First you analyze the economy, then the industry, then you come on to the company. That is called the top down approach. And the bottom up approach is, first you start analyzing the company, then if you like the company, then you go on to the industry, and then you go on to the economy. My favorite way is to go bottom up. First you check out the company, then you go on to the industry, and then you go on to the economy. That is how it should be always, because many a times what happens that your economy is not doing very well, but the company is performing outstandingly well. So that is why you can understand, and you can go, and you will definitely make money from the company itself. If the stock prices of the company that you are invested in are growing, then only you will be able to make great money. Further, we'll be covering up more details on PE, EPS, debt management, and price to book value, and what is book value and all that in the future lectures. So thank you guys for watching this lecture. I'll see you in the next lecture. Hi guys, welcome to this lecture, and in this lecture we'll be discussing about various factors how you need to start analyzing fundamentally. So first parameter, can you understand the business model? That is the first question that it should come to your mind. So in order to do that, what you need to do is, any company that you take or you start analyzing, you need to go to the website of the company and see the products that are available on the website and what services does the company provide. Further, other than that, you can even go and start analyzing the company and find out new companies also. If you are, let's say, traveling in a metro, maybe reading a book, who's the publisher, maybe you're in a supermarket, that can help you find out new companies, because supermarket has so many products. You can just pick up the product, just turn it around, just see the name of the company behind the company, which is the manufacturer company or the marketed company, if there is limited written. So if the company is, let's say, ITC Limited is the company, so if it is limited written, most likely it's gonna be listed on the stock exchange. Just open up your app, check it up if the company is listed. If the company is listed and you can see the basic parameters are very good, which we'll understand in this lecture and the future lectures, then you can just go on and start investing in the company. So first thing is that if you can relate to the business model, if you like it, if you see a future for it, so that is the most important thing firstly. Then second, we go on to price to earning ratio. Price to earning ratio is the PE ratio. That is a very important factor which people and analysts use all over the world to analyze and predict future prices. So in order to understand PE ratio, first we need to understand the earning per share. So everybody knows that the company is making profit. So when the company is making profit, whenever we divide that profit by the total number of outstanding shares, so simply you will see in the next video that, or maybe you must have seen it, that from where you can see the total number of outstanding shares for a company. So when you divide the net profit divided by the total number of outstanding shares, you get the earning per share. Earning per share means the profit that the company is making per share every year. If you are dividing it on a quarterly basis, then you will see on quarterly. If you are dividing it on a yearly basis, you will be able to see on a yearly basis how much money the company is making per share. So moving on from earning per share, we'll go on to PE ratio. PE ratio simply says that price divided by earning per share. So we've discussed earning per share already. If the stock price of a company is, let's say, trading at 100 rupees and the earning per share is, let's say, 10 rupees. So this means that your price is trading at a multiple of 10 times of the earnings. I hope it is very clear that the price is trading at a multiple of 10 times of the earning per share. So this is what is called as PE ratio. So from this figure, you can simply see that if the price is, let's say, not 100 and let's say it is 200 and the earning per share is still 10 rupees. So you can clearly see that the price is now higher than what it was earlier. So now the stock is pretty overvalued. We can simply see that the stock is pretty overvalued. Earlier the PE was 10, price 100 divided by 10 gives you a PE of 10, and now the PE is 20. So from this example, you can clearly see that the lower the PE, the better it is. Because if the PE is lower, That means that you are getting more money, in the sense, in financial terms particularly. This has no relation with the market trends, okay? But still you can see that if the company has a lower P, that means that the company is generating more earning per share on the amount of investment that you are doing in the price. So in first case, 100 divided by 10, the P is 10. That means you are giving 100 rupees for making 10 rupees of earning per share. Whereas in the second case, you are giving 200 rupees for making 10 rupees per share. So obviously it is, the first case is much better. So this is what is PE ratio. We will further understand it more while we are analyzing other companies. Debt is another third factor which is very important, which we need to analyze and which we need to see, because debt plays a major role in companies getting busted and bust completely. Because if the company is over leveraged and the company has taken a lot of debt and is not able to even pay the interest costs, then the company is bound to go down and get bankrupt. So we need to see from the balance sheet if the company has debt or not, and if it has debt, whether is it using it strategically or not. Because if the company does not have any debt and only the owner's money is there, or the money which has been taken from IPOs or listings, because if you are taking debt, what happens, the interest cost of debt goes and gets deducted from the profit that you are making. So if you are making 100 crore rupees and out of which 20 crore rupees is your debt, so if earlier, if you would have not taken debt, you would have had to pay taxes on that 100 crores that you made. But you have taken debt, a decent amount of debt, not very high, and the interest cost of that debt is, let's say, coming out to be 200 crore or 20 crores. Interest cost is 20 crores. So if the interest cost is 20 crores, now your total profit is coming out to be 80 crores in the company. And if it is coming out to be 80 crores, now you'll have to pay profits only, or you have to pay only taxes on 80 crores and not 100 crores. So that is why debt plays a very good advantage when you are wanting to expand and grow, and interest costs help you save tax also, because you can expand more and still on the same time you can pay less taxes. So that is why debt is very important. Then we come on to the ethical management, that if the company is doing a good job, firstly managing the company, secondly if the management of the company is ethical or not, that can only be done by due diligence and reading about the owners of the company, and is particularly the toughest thing to do in any company. In India, we know Tata has a great name and Tata is particularly extremely ethical, so we can just blindfold and we can see that we can just trust on it on ethical parameters. So that is what is management, and we need to make sure that management is good, because all the numbers that we are getting in front of our screens, and if they are rigged, we will be in deep trouble. So we don't want that. So that is why management should be important. And then we can come on to book value. So book value or price to book value is the value that you will get per share if the whole company is liquidated. So book value is one number that you will get. So for example, your price is 100 rupees and the book value of the stock is 150 rupees. That means that you are getting the stock currently at 100 rupees, but the book value of the company is 150 rupees. That means if the company is getting liquidated completely, you will get at least 150 rupees. That's a upfront profit of 50 bucks, but that will only happen if the company is getting liquidated, which will not happen ever until unless the company gets in deep trouble. So that is about book value. So these are the most important factors that you need to understand when you are investing and analyzing and getting onto fundamental analysis. So that's about it for this video. Next lecture we'll be discussing practically how to use all these things that we've done, and we'll be seeing practically on the screen from the computer that how we need to use all these things to our advantage and how we can analyze further. So thank you guys. I'll check you out I'll see you in the next lecture. Hi guys, this is Zan from PhilLife, and today we'll be talking about fundamental analysis. So all the data and all the data that we are getting in and you're learning from this exercise and this lecture, the thing is that if you're not able to use it and make money out of it, there is no point learning all these things. Obviously it is very good information, you'll get grasp a lot of data and you'll when you're talking to your friends and all that, you'll be able to say some jargons after attending the course, but the course is hardcore there to make and help you out making money. If you're not making money after doing the course, it's not beneficial. So today we'll be talking about analyzing the fundamentals, analyzing the charts, and in the next lecture we'll be discussing about how you can find a good price and whether you can invest, whether the price is good for you to invest or not. So let's get started on the practical stuff and analyzing companies, practical companies. So going on to money control, that will be the first thing, and the second site you can open is screener.in. So these are two websites which are extremely useful for you for various kinds of analysis, and you'll get a good data from all these websites. Then thirdly, you can go onto the company website and see the annual report, which will be also extremely useful. So if we go on here and let's say I'll just take a company called as Shilp Gravure. Okay, so this is one company which I recently analyzed. So this is one company and we are taking this as an example and we'll analyze it. It's a small company, but it's going to be very useful and it's very clear for understanding. So Shilp Gravure is one company that offers engraved copper rollers and printing plates. So you've seen, so firstly we are going with the business model like we understood in the last lecture how we have to go about it. We'll go and analyze the company in the similar pattern. So what Shilp Gravure does is, it is one company that is into giving textures to leather, glass, PVC, aluminium and various other textures like paper, board, everything. So if you see the texture on various kinds of these materials available in the market, most likely it has been given by rollers that have been manufactured by Shilp Gravure. So Shilp Gravure is one company that manufactures those plates and rollers. So I think the field is pretty interesting because all the leather bags that you see, or the handbags of women or men, or if you see a leather coating on, let's say on the seats, all that texture that is coming, Shilp Gravure is a big part in giving that texture, and that's going to be there forever. All the clothing that you see, Shilp Gravure is actually making a big contribution. So I really like the business model. Now we'll move on and try to understand. Obviously there's a lot of competition in all those lines, but for this company, let's see if we like it and if it's worth jumping into or not. So let's get started. So here we can see the market cap. So market cap, I earlier told you that market cap is the total outstanding shares multiplied by the price of the stock. So the current price of the stock is 88.85 rupees per share, and the 52-week high low is that the stock has gone minimum to 80 rupees and maximum to 179. So the price has corrected from there and has come down pretty steeply. The book value of the stock is 106.90. So we've earlier talked about book value. So if the book value of the stock is higher than the price, that means we are getting, that is one analysis point. I would like you guys to make a note of it, clearly write it down, that book value is higher than the current market price. That means that it can be undervalued. So this is one tick mark which tells you that the company can be good and is good. Then moving on, the PE of the stock is 7.35. That is also pretty low as compared to what usually we see the PE in the market. So PE is pretty low. So this will tell you, when we are investing 1 rupee, 1 is the earning per share in this case and 7.35 is the price. So this can simply be calculated by dividing the current market price divided by earning per share. Dividend, the company is giving a dividend of 1.76% year on year. Return on capital employed and return on equity is 12.06% here. Moving on to sales growth, the company has been doing a sales growth of 4.26%. We'll be covering up return on capital employed and return on equity later on. So here we can see the chart of the stock. The chart has been growing like this, 3 years, 5 years. We can see that the chart has been growing up and then corrected right now. So this can be a good moment to jump into the stock because it is corrected and the price is low right now. We can see some pros and cons here. Further, we can see the peers here, and we can see the PE ratio of the peers. So some of them are looking pretty good, some of them are looking bad on the basis of PE. The lower the PE, the better it is, but still it's got some parameters attached to it, which we've discussed about in the earlier lecture. So here we can see the quarterly figures, how the company has been growing on a quarterly basis. So in India particularly, our financial year starts from 1st April and ends on 31st March. So on that basis, we can see here for the last from 2016 to 2018 December, all the data. Further, we can even see here that how the company has been growing from 2007 to 2018 and what sales the company has been making. So in 2007, the company was making a sale of around 26.18 crores every year, which it increased to 67.63 crores every year in 2018, which is pretty decent, pretty good. So the company has nearly doubled, or rather more than doubled, its turnovers. TTM here means trailing 12 months, as in from current date of March 19, 5th March 2019 and 12 months behind this. So it is adding up all the quarters and everything and telling you that the company has done a turnover of 74 crores till now over the last 1 year. So these are the expenses, the operating profits. So the company has made sales of this much, the expenses in the company were this much, the operating profit came out to be 14.68 crores in the year ending March 2018. The operating percentage margin was 21.71, which is pretty good. Other incomes, maybe from rent or some other businesses that the company has got, is 1.40 crores. So that is decent, and the depreciation that it got is 6.59, and the profit that the company got here, profit before tax, came out to be 8.50. The taxation that the company paid was 17.29. So you can see the difference in taxation here, because sometimes the tax has been paid in advance, so that's why the total tax is coming out to be less here. Overall, the taxation will come out to be around 26% only, the corporate tax. Net profit, if you see, the company is coming out with a net profit of around 7.03. So if this 7.03 is divided by the total number of shares, you will get the earning per share. So here the earning per share is coming out to be 11.44. So overall the company is looking pretty decent. The earning per share is 11.44, and now if we divide the price of the stock, that is 88.85, divided by 11.44, the earning per share, we'll be able to see that the stock P is coming out to be 7.35. So that is how stock P's are calculated. Now moving on to the balance sheet, we can see here that the balance sheet of the balance sheet is clear, and you can see that reserves and surplus is a very important part. Reserves are those money that the company has been making over years and is clearly available and seen in the balance sheet. Reserve does not mean that the company has all this in reserve, as in it is not using it at all. The company uses its reserves particularly in the way of in short-term loans and all, and in financing its purchases also. So reserves is not something that is kept as a reserve completely and logged into the locker. It is not like that. It does help out in the regular business cycle. Borrowings are the liabilities that the company has taken for a long-term period of time. It's particularly long-term loans. So in this case, we were not able to see any massive interest. The interest is very small, of 0.99. So the company has a very small loan of only 10 crores or 10 crores. So that is not very high. So the liability and the loans in the company are pretty less. So it can be another tick point and it can be beneficial here. Thirdly, obviously company in profit is also beneficial, so that you can also take as a tick point. So the notes that you are making, please write down that firstly the debt should be low, that is one point. The P should be low, that is another point. Thirdly, the company should be growing and making profits, and that is a very important point. The sales should not drop. The sales should not drop at all, because if the sales are dropping, that means that the company is not making people satisfied and people are leaving the product. So sales should not drop, rather the profits can drop, but the sales should not drop, because the profits can drop because of some marketing reasons or some other reasons. So that is why it is very important to see this. So here we can see cash flows, and so cash flows for the company, the operating, investing and financing cash flow. The company made 9.72 crores in March 2018 overall for that year as operating cash flows. Investing cash flows, company made a negative of this much, so it must have made some investments outside, and financing activities were very meager of 0.04. So here we can see some more ratios: return on capital employed, debt turnover ratio and inventory turnover ratios. So we'll be discussing all these later on. Moving on further, we can see, moving on further to the money control website, if we write down the same company here, Shilp Gravures. So Shilp Gravure, if we click it here, and we can see all the details of the company, and it will open up, and the price of the company is 90 rupees. These are live prices. The prices that you were seeing on screener were not live, so that price was closing as per the last working day, last day the market was open. So this was the last closing price, and this is the live price. So you can see the last closing price here also is same. Previous close is 88.85. Okay, you can see the high low, 52-week high low, today's high low, that the stock has been fluctuating up and down. And then you can see the advanced chart here if you click on it, but we would not like to go there, and further we like to discuss about other things here. So this is particularly the market cap. You can see the market cap here. You should particularly see, wait, you should particularly see the market cap. You can see the PE ratios here. These are not mentioned here right now because sometimes there are some glitches in money control website, but it should be mentioned for various other companies that you see. The book value is mentioned here, the price to book value is mentioned here, and the dividend that is making. So we always have to see the dividend yield and not the dividend percentage, because that is given on the face value. So dividend, if we like to calculate the dividend yield, so particularly face value is 10, and if the face value is 10, what will happen, you will just multiply it with the dividend percentage here, that is 1.5 rupees will come out, and the company is giving you 1.5 rupees per share on the investment that you've made. Okay, so that is how you calculate, if you want to calculate from this dividend percentage or on face value. And dividend yield is exact money that you are getting into your bank account on the investment that you've made on the shares. And P here tells you about the industry P, 23.72, that is the industry P which is prevailing. And as we saw in here that the P currently in this stock is 7.35. It is not updated yet in money control, but for other companies obviously you can try it out and we will see it together. So P is very important. So it is trading at a lower P, so that's also a very good thing. And deliverables means the number of shares that were taken for delivery from today to next day. So we'll be covering up this in the basic technical analysis that we do, so that'll be covered up there. So this is what I wanted to explain about money control right now. In the next video we'll be discussing about money control more, and since we've already covered screener.in, we'll be talking about money control completely, and we'll see how it can be used for analyzing. So I'll find you and catch you in the next lecture. Thank you guys for watching. Hi guys, in this lecture we'll be discussing about money control and how we can find out and research stocks. So earlier lecture we discussed about screener, and this is money control, and this is more detail as compared to screeners. So we'll take the same company, Shilp Gravures. We just write down the name here and we click on the company. So after clicking on the company, we can see various details. So the company is only listed in BSE and not listed on NSE. Okay, so these are different exchanges. Either you can raise money by investing on BSE, or you can raise money by investing in NSE by the NSE route. So the company is only listed on BSE, and the price is trading at 90.20, and it is today 5th of March. And you can just see here that all the details are mentioned here, the basic details which we understood here. And going on to standalone means that the company that you are analyzing or investing in has only one company and does not have any subsidiaries. So it is, you can, for example, you can understand it like a family income, and individual incomes. So individual income will be categorized as standalone and family income will be categorized as consolidated. So a company can invest in various other companies and take a majority share, let's say buying more than 51% of other companies, then what will happen? It will become a consolidated company, and the balance sheet and the profit and loss statements will show you all the details of various other companies that the major company has invested in, or the parent company has invested in. So other companies are like subsidiaries. So we always have to analyze by understanding consolidated figures and taking consolidated figures. The price of the stock will always show you details of consolidated. So don't get confused by just taking standalone figures. In this company, the company is actually standalone only and does not have any consolidated or investments in other company. We'll further see it when we open the balance sheet also. So here we can see all these basic details here which we discussed earlier. Then now what we'll do is we'll move on to other details which are very insightful. So advanced chart, if we click on the advanced chart, we'll be able to get the charts here, which will tell you about the movements of the stock and how it has been performing and growing over the last 5 years or maximum since the inception or since it got listed on the stock exchanges. So here are the charts, similar things we saw on screener. So moving on further, we can go on to financials here. This will give you a lot of data on and good data about how to analyze companies. So you can see here the stock price also rose instantly, and earlier when we were starting the video, it was at 90 and now it's at 92. So that is how you can see the price movements. So had you purchased it at 90 rupees, you can simply sell it at 92 rupees and get out of the market, making a profit of 2 rupees per share. So here we can see so consolidated, if you see, we are getting data, are we? So yes, the company is actually consolidated and it has some consolidated minority shares. It must be having some minority shares in other companies. So going on here, we see the consolidated figures, and the most important thing that we need to see here is the debt and the loans. Is the company over leveraged? Does the company has a lot of debt? So in this case, it has a very meager debt of around 57 crores overall, and the long-term debts are only 1.38 crores. That is very less. So that is the most important thing that we need to see. So in this course, we are covering particularly those important things that will help you in analyzing and going further to make a good investment decision. So these are the most important things that you need to see. I already gave you a checklist in the last lecture that how you have to go about it and what all you need to see. So those were the most important things. I'll keep on adding to those that list so that it gets a one consolidated list of all the important things that you need to see when you are investing in any company or analyzing a company. So after that, you need to analyze what are the tangible assets in the company and what are the fixed assets. So tangible assets are 44 crores. So that means that the company has tangible assets, means property or infrastructure of 44 crores, and the current market cap of the company, like we saw it earlier, is 55 crores. So that is a wonderful deal that is coming out to be here in here. And further, we can even see what the current investments and current things are, and cash equivalent. So you don't really need to go deep into this on the basic analysis, but this is very useful. Okay, so these two things are very useful in this. Firstly, if the borrowings are not very much, and how much fixed asset the company has. So overall, the fixed assets the company has is around 44 crores, and overall total assets the company has is 73 crores, which is pretty good. Moving on to profit and loss. Clicking on profit and loss, we get here that the company is doing a turnover of around 68 crores in standalone, and in consolidated, let's see what kind of turnover the company is doing. I think it will be pretty much similar only. So yeah, here, so the turnover is particularly similar. So the consolidated company is not really making a difference on the standalone. So either we can take standalone figures here, or we can take consolidated figures. In this case particularly, because the difference in consolidated and standalone is not a lot. In companies, big companies, usually the difference can be very high also. So here particularly, the first thing that we see is that what are the sales and have the sales been increasing or not. But we won't consider this because this is March 2016. We need to make sure that, so we'll go on to standalone figures and see the live data for 2018. And so seeing here that coming on to March 2018, we can see that the profits, the turnover of the company was 68.05, and trailing down, reducing all the expenses, cost of the material and everything, and finance cost and employee benefit expenditure, etc., etc., we can see the extraordinary, and the profits have come out to be 8.50. This is how you analyze that the company is good, the profitability is the sales of the turnover is going well and they have been increasing, so that's a good thing and that's fine. But other than that, we can even see that the profits of the company have also been growing from 6.34 crores, it has increased to 8.5 crores. That is pretty decent and pretty nice. Further, this is the profit, actual profit that the company has made. This is the net profit that the company has made, and it has been growing from 4.23 crores to 7.03 crores overall. And you can see all the diluted and the basic earning per share, so both the figures are same only, so earning per share here itself. So these are practical things that you need to see if the company has been growing or not. Moving further, all the ratios you can check out here in this column here after clicking on ratios. So you will be able to see all the profitability and margin ratios. Firstly, you don't really have to get troubled by seeing all the numbers here, so you just have to see the basic figures here, the net profit margin the company that the company is making, regular profits, how much percentage margin that the company is making, and what kind of return on equity and return on capital employed the company is making. Usually all these figures should be at least more than 10%. Okay, and ratio, you just see all these things and you can skip it on. Later on we'll be analyzing more things. So for basic analysis, this is done. You just have to see all these figures. Moving on, we can go on to shareholders and we can see the number of shares which are available. So obviously this site is more comprehensive as compared to Screener. So here, going on and checking out the shareholding pattern, you can see the company has 31% shares invested, or by the company or the promoters have a holding of 31.95% shares. And foreign investors and individual investors have a 28% holding shares, and approximately 1770440 crore share, 144, these many number of shares purchased, and 28% holding is there. So the total promoter holding is around 60.73%. Rest mutual fund is coming empty, so mutual funds don't really have an investment here. Individuals have invested here around 5,000 and around 1.8 million shares have been purchased by individuals, around 29.72%. So overall, if we see here, total 100% investments are there. None of the shares are pledged here. If they had been pledged, they would have been mentioned here. Pledge means that your shares have been given on mortgage to some bank or some institution and taken money on that. So that has not happened here. Total number of shares that are there in the company are 6.14 million, that are the total outstanding shares. So in order to take out the earning per share, what you can do is simply divide the profit by 6.1 million shareholders. You will be able to get the profit. So obviously 7 crore the profit that was coming for this company, divided by 6.1 million, that will give you the total earning per share. So that is the total details about this company. Corporate actions, you can see all the profitability, all the bonuses or dividends the company has given. We'll discuss about dividends and bonuses very soon, okay, in the next lecture particularly. So you can see the dividends and bonuses the company has given right here by clicking on this, and you can see whether the company has given you any bonuses. So there are no bonuses here. If the company stocks has been split or not, you can see all the details here. So particularly that's about it, how you can analyze all these things. So overall feel that I'm getting is the company has a low price right now. The price has been corrected and has fallen from a very high level of 179. So that is one good point that makes me feel like investing in the company. The company has low debt, that's another good point that makes me feel like investing in the company. The price of the stock is down, that is also one very good thing. The book value of the company is higher than the price, so that is another point that makes me invest in the company. The fundamental model and the models, the business model of the company, I like that is also very good. That helps me understand the company very well, so that is another benefit. And so all these parameters are looking pretty good. So these are the major things that you need to see. We'll be understanding the financial model which we make, and that'll be extremely beneficial for you to understand. We'll be picking up all the financial data that we need from these websites itself, and that'll be helpful. And Shilp Gravure, we can even check it out, or we can even check out the website of the company. So the company has been functioning from Jaipur particularly, and this is the website of the company. So B2B businesses particularly, the website won't be very fancy, but you must always check out the website of the company and the products that it is making and what the company does. That is very important. And further, you can even go on to indeed.com and different online sites which tell you about how's the culture in the company. The culture in the company also depends a lot, and that will definitely be that will come into the ethical parameter, but that's also very important to be seen. So that's about it for this video. I hope you like this video, and I will see you in the next lecture discussing about the fundamentals and how the financial model works and how you can analyze and predict the future prices of the stock. So we've covered pretty much most of the stock basic stuff on fundamentals, and next we'll be analyzing how to grow and take out the price for the future of the stock. So thank you guys. Check you out in the new lecture. Hi guys, welcome back to the lecture, and in this lecture we'll be discussing about three very important tools that we need to understand in order to understand finances, how the finances work for the world and what kind of returns that we can get. So the three formulas that we need to understand are the present value formula, the future value formula, and the percentage return formula. So simply what we'll start with a very simple thing, that let's say I invest around 12 lakh rupees 12 lakh rupees invest and in a property, and now that investment property of 12 lakh rupees has increased to around 49 lakh rupees. Current value is, let's say, 49 lakh rupees. So what I need to do is I need to find out that what kind of percentage returns have we got here. So in order to see, I will need one more value here, that is the number of years in which that the amount has increased in the property value. So from 12 lakh it has increased to 49 lakhs. So let's say it has increased in a period of 9 years. So was it a good investment? Was it better than the FD returns that I was getting? That is what we have to calculate here. So for that, simply we'll have to put the formula of rate and open up the Excel bracket. So for Excel, you'll have to put equals to sign to open up or use formulas, then write down rate and open up the bracket. Then you have to go to number of years. After going on to number of years, what you'll have to do is, what you'll have to do is you'll have to put a comma here, and after putting comma, we don't have any PMT is regular payments. If we are doing, in this case we are not doing any regular payments, so we just keep it as negative, as we'll just skip it. PV is the present value, the earlier the investment value that we invested. So in this case, as money is flowing out of our pockets, we put a sign of negative 12 lakh rupees that we invested earlier, and then the money that is coming in at 49 lakh rupees if we tend to sell the property. So we just put that and close it and hit enter. So it should come out here. If it is not coming out, so the problem was that we didn't select number of years. NPER was wrong. The NPER should be, number of years should be this C8. So we had selected wrongly some other column. So if we hit enter, it is telling us that we got a return of 17% year on year, which is pretty good as compared to the 6.5% returns that we get on FD. So that is one way of calculating the percentage returns that you are getting, and it's an awesome and very simple way of using Excel to calculate this. Moving on further, what the next question comes here, if I want, and if I've invested, let's say 12 lakh rupees, and I want to increase it to 49 lakh rupees, what will be the formula to do that at the rate of 17%? So I know my rate of returns here. Now the scenario has changed, and let's say we have all these figures. here this is rate calculation. This was used for rate calculation, so I'll just put it as rate calculator. Now what we are trying to do is, this is my rate already that I've calculated, 17% approximately. If I open it up, increase the decimal places, so this is now what I'm trying to calculate is that if I investment value meant, let's say 12 lakh rupees. If I invest 12 lakh rupees at the rate of 16.92% for 9 years, what my money will increase to in the next 9 years. So in order to find out that, I simply put a formula called as FV, future value, and simply open it up. Then I put the rate, so rate is 16%, comma, number of years is n per, that is 9, then comma, then I leave PMT as empty, and then I put PV as negative of 12 lakhs, and I close it. So this will tell me how much money this 12 lakh investment will increase to over the next 9 years at the rate of 16.92. Okay, so it is increasing to 49 lakh rupees if I invested for 9 years at the rate of 16.92%. Had I invested in FD, how much return would have I got? So in order to calculate that, simply I interchange or change this by 6.5% and I hit enter. So I was getting 49 lakh rupees. If I hit enter, I would have got only 21 lakh 15,000 rupees if I had invested this money in FD. So that is why this is very important, and you can easily see that this is an automated model. So that's also very nice. If you are getting a return of, let's say, 8%, you have invested in debt, so you would have got around 23%. If you are investing at 16%, you will get 45 lakhs. If you are getting, let's say, R amount 16.92, you will get approximately 49 lakh rupees. So this is what is used for calculation of future prices. Now thirdly, this is calculating FV, future value, So now the third parameter will be Alt HBA. So now the third parameter will be, if I want to calculate that how much money should I invest in order to get 49 lakh rupees. So for that what I do is, I need, let's say, after 5 years I need so the question is, how much money do we have to invest in order to get 49 lakh rupees? So I invest 49 lakh rupees, and I need this much amount of money in, let's say, 7 years, in 9 years itself, and my rate of return, I keep it same as 16.92%, so that it's easier for you guys to relate. So my future value, what I want is, I want 49 lakh rupees, and this is my number of years, let's say years, and this is my rate at which I'm expecting that my money will increase at this rate. So if I need this much, 49 lakh rupees, how much money should I invest right now? So for that I need to put the PV formula. I put in the equals to sign, open up the bracket, so first I put PV formula, then either I can press tab in order to convert it into a formula and start writing the formula, navigate to rate, then put a comma, number of years is 9 years, then put a comma, then PV is, let's say, PMT is empty. That means if I'm putting in regular money also, I'm not doing that. So regular money I'm not putting in, and FV is 49 lakh rupees. So if I put and if I close it, it is telling me that I need to invest a negative of 12 lakh rupees in order to get 49 lakh rupees over the next 9 years at this rate. So Alt HBA. So this is simply telling me that how much money I have to invest in order to get 49 lakh rupees in the next 9 years of investment. So clearly we've done three of the most important things that we'll be needing for any kind of analysis in stock markets and particularly financial modeling. So these are the most important parameters that we should look at. I hope this video was very clear and simplified for you guys to understand, and that's about it for this video. We'll be coming up with new videos and we'll be putting up a new financial model for you so that you can analyze and predict future prices very easily. So thank you guys for watching this lecture. I'll catch you in the next lecture. Hi guys, welcome to this lecture on fundamental analysis. What we'll be covering will be that how to analyze future prices and how particularly you can analyze your prices for a longer period of time, for let's say 3 to 5 years, and they can be pretty accurate and can give you great returns. So moving further, let's get started and try to analyze them, and let's try to understand how we can go about it. So getting started, we'll have to go on to Excel, and if we'll have to open up Excel, and opening up Excel, we can start with fundamental analysis, financial model, and so we can start with, firstly we'll have to pick up a company on which we'll like to analyze. So let's take VIP Industries only. In Reeves. Moving further, so I'll give you a little brief about Excel also. So here we've got Excel, and it's got rows and columns. So if you want to put any formula, let's say I want to add 45, I write 45 here and go down and write let's say 56 here. If I want to put any formula, and I'm just giving you a brief up about simple formula of Excel. So in order to start using a formula, you would have to click on the equals to sign, and then open a bracket by clicking shift and the 9 key on the numpad, or not on the numpad particularly, on the top side. And you have to write SUM first. After selecting SUM, you have to then open the bracket and navigate with the navigation keys, and in order to connect both of them, you'll have to press the shift button and go down and then close the bracket. If you do this, so simply the formula is looking like this: sum, then you open the bracket, C9 dot dot C10, and then you close the bracket and you hit enter. So total amount has come out to be here. So you can clearly see this formula. If you double click on the formula, it will tell you what the formula is. Formula is sum, bracket open, number 1 and number 2 addition. So that's about it. So that's a little basic about Excel. If you try using on Excel, and if you're a complete beginner, you will definitely get to know a lot of things from the model that we create here. So this model is used particularly to analyze and predict the future prices for the stock by a very simple method of forward analysis and forward PE. So let's get started. So for VIP Industries, what we'll have to do is, this is an extremely simple method that I'm telling you. We have already discussed about earning per shares. So we simply try to find out the earning per share of the stock. So what we do is, we go on to VIP Industries and we open up screener.in, and after going on to screener.in, we write down our company, VIP Industries, and then simply we scroll down and we go on to earning per share. So this has been the earning per share of the stock, and so we take data for the last, let's say, 5 years. Okay, for 5 years, when we take the data, we just go here and we paste the data itself here. So this is the data for 2014, 2014, then 2015, then 2016, then 2017, and then 2018. So this is the data for the last 5 years. Okay, so if I want to find out at what rate this earning per share has been increasing, so for that I will have to put a formula of rate. So I know that the total time period here is 1, 2, 3, 4, 5 years particularly. So we'll start from 2015, 1 year, 2 year, 3 year, 4 year, and 5 year. So what we do is, we put our years here as 5, and number of years we've got the beginning value, that is we want to see from 2014 to 2018 at what percentage has the earning per share been increasing. So for that we put the formula of rate, RATE, we write down rate, open up the formula. So now here just try to analyze and see it and be concentrated here, because NPER is number of years, so we just write down number of years. PMT is regularly if we are adding some earning per share, so we are not doing that here, so we just put another comma and leave it blank. So PEV is the present value or the initial value that we want to increase from. So the initial value will be here negative of 3.79, and then the future value, that how to what level has it increased. So this is coming out to be the level to which it has increased. So if I put in enter here, so this is telling me clearly that the rate of increase is 17% every year. So if this rate of increase is 17%, if I want to increase the decimals, we can just click here and increase the decimals here. So I can clearly see that this has been increasing at the rate of 17.42% on every year or year on year. In order to calculate for 2019 and all, what I'll have to do is I can simply either write 2019 till 23 or select these two and then click on this button and drag it down to, let's say, 23. So now if I want to take out the new earning per share for 2019, assuming that this earning per share will continuously keep on increasing at the rate of 17.42%, I simply go here and I write down the rate of return by which I want to increase it. It is 17.42%. okay, and I then copy this on the right side, simply this rate of return. So in order to increase 8.46 sorry by 17.42%, I put a formula like this cell plus bracket open this cell into the cell below that with the percentage. So this will clearly tell me, so this formula is telling me that add 17.42% of 8.46 with 8.46. so this is what the whole formula is. If I put in enter, so I get this formula, I get this figure here. So I'm simply dragging this. So this is improving and increasing in a uniformed manner, and now the new figure here is, so you can see the formula is also dragged on the right side, and now it is saying that adding 9.93 with 9.93 percentage of 17.42. so this is increasing again by 17.42. then in 21 the figure of 20 has increased by 17.42. then 22 the figure has increased by 17.42, and this is how it has increased to 18.88. so this is the new earning per share that I am expecting that the stock will be trading at after the next 5 years. So I hope it is clear till now. Earning per share, we've done simple maths calculations here to take out the future earning per share of 2023, assuming that the stock will increase, the earning per share will increase at the rate of 17.42% every year. So now moving on, we need to take out the PE band, So what happens usually whenever you see your PE always moves in a sideways movement. So what happens? PE is price divided by earning per share. We all know that, we've read about it, and I've already told you in the earlier lectures. So price divided by earning per share, what happens is that whenever, let's say, your earning per share is increasing or your net profits are increasing, somewhat over the years your price will also increase. So if your price is also increasing and your earning per share is also increasing, so what will happen? Both the figures are increasing, then eventually it will continue to stay in a band. So for example, you had a price of, let's say, 234 and your earning per share was, let's say, 34. So your P was simply, I'm putting the formula 234 divided by 34. So this is my price and this is my earning per share. I'm just taking an example here. So this is my PE. Okay. Now what happens? My earning per share increased to, let's say, 39 after 1 year, and my price all stays same, 234. Let's say it doesn't decrease. People have not yet noticed it, and I again put this formula, this divided by this. Okay. So I'm getting it as 6. Then again what happens, my earning per share and the company is making profit, earning per share increases to 43 and my price increases to, let's say, now people realize that the company has been growing and it has been making profit, and now the price increases to 400. So simply we can again divide this and by this and we get a PE of 9. Then again my earning per share increases, but increases marginally to, let's say, 40, increases, let's say, 45, but my price is still increasing and now it is 570 rupees. So this is my new, let's say, earning per share, new PE 12. Then again what happens, let's say my PE stays this, my earning per share stays the same and my price falls down to 483. So now my new earning per share, new PE will be, I've simply selected these two columns and now I'm pressing Control R. So it's gonna drag the formula here. So you can see the formula has been dragged here. So simply it is coming out here, and now I can see that my PE has been moving up and down in a continuous band. Again what is happening, let's say my price is increasing, again the company makes good profit, it has increased to, let's say, 50, and my price has also increased to 520 rupees after 1 year. So again I'm dragging and pressing Control R. So my new PE is this much. So simply if I want to see the chart of this PE, I can select all the data. I can go to insert, and after going on to insert, I press here insert a line chart, simple line chart, and now I can see that my PE has been going up and down in this way. So always your PE will go up and down in a similar fashion like this, because obviously your price will continuously increase and your earning per share will also increase if the company is making profits. So that's what I wanted to explain here. So simply what we'll do is we are going to change this data, and simply we are going to substitute this data by selecting this for 5 years. Okay, and we are going to paste it here. We are going to paste it here and remove this. Okay, so what I've done is I've just copied it, Control C, Control V, and copied it and pasted it here. For this is for 2014 and this is for 2015, and simply I can 2016, 2017 and 2018. Okay, so I've simply kept it right. I'm not using a lot of automation because I could do it extremely fast, but I'm not using it so that you guys can simply see how things are moving. Okay, so I just highlight this by pressing Control B, so I can simply see here these are the actual earning per share of VIP Industries. Now we need the price for the last 5 years from 2014 to 2018. So we'll see how the price has been moving. In order to get the prices, what we'll do is we'll go on to the website of, let's say we go on to this website only, and we click 5 years. And what we'll do is we'll pick up data of the stock for 1st of June every year. Why we are doing that is because whenever we pick up data on the 1st of June of every year, usually what happens, the annual report, the financial year is ending on 31st March 2000 whatever, and within 2 to 3 months we can see the price, we can see the impact of the news and the results in the stock prices. So the prices are discounting all the news and all the results that have been out in the market. Eventually the price will show you all the data by 1st June. So that is why we are taking the price of 1st June. So for the last 5 years what we do is we take the prices of 1st June. So firstly we'll take for June 2018. So here 1st June it was 416.42. So we go on to our chart here, we write down 416.42. Then we move on to the next price bracket of 2017, that is let's say we'll take it as 2nd June 193.49. So we take it as 193.49. So here we move on to this level, then after 193.47 then we go on to 2016 and it is coming out to be, let's say, 114.01, 114.01. Then 2015 it is coming out to be 96.68, and 2014 the price was June is here, 105.63, 105.63. So this is the chart. So you can see clearly the PE of the stock has been growing up and the price has been growing up massively. So it was extremely undervalued within this time period. In the starting years it was extremely undervalued and the PE was 27. So lower the PE the better it is. So I jumped into the stock and purchased it when it was 88 rupees. So that was the time when I first saw the stock and purchased it in 2014 itself. So I made pretty good decent amount of money on this stock. So this is how your PE has been growing. So we can simply, what we can do is we can put a formula of the maximum and minimum PE. So maximum PE has been, I put a formula of maximum and I select this range, so it will give me the maximum figure, and then I put a equals to sign and write minimum and open up the bracket and select this range, so it's gonna give me the minimum and maximum PE. So this is maximum PE and this is minimum PE. So this is how I get the maximum and the minimum PE. So now simply we know price divided by earning per share gives us PE. Okay, so price divided by earning per share gives us PE. So this is very clear here. So simply if I want to find out the price of the stock for futures, for the future prices, simply what I can do is I can just multiply the PE into my EPS. So PE, I know that it will always stay in a band, okay, and it is this band in which the PE is staying at, assuming that it's gonna stay in this band only. So if the PE stays between this band and I know the future EPS, which is this one, okay, so if I know my future EPS, which I calculated earlier, simply what I can do is I can multiply my lowest price and lowest PE, highest PE with the future earning per share in order to get the future price, and the lowest PE in order to get the future price of the stock. So by this analysis I can see this is my highest price, and this is my lowest price. Simply if I want to increase this, I can just click here and increase it so that I can see the whole data. So these are coming out to be my lowest and the highest price. So let's go and see the current market price of the stock. So the current market price of the stock is 438.50. So CMP is 438.50. So this is my current market price. So I am expecting that the stock will somewhere increase between 500, it will trade somewhere between 500 and 928 within the next 5 years. So it's going to increase and it's going to be that level if it continuously increases by 17.42%, which we calculated here by putting the formula of the rate. Okay, I hope it is very clear. So this is how you can make a financial model, and this is how you can analyze how high the price of the stock can go up to. So that is what I wanted to explain in this video. I hope you guys enjoyed it and liked it very much. It is a very simple way of calculating future prices of the stocks, and similarly you can check out my YouTube channel, and we've done same analysis in a similar fashion for n number of companies, but that analysis is a little more detailed as compared to this one. So we've done it for more than 200 companies, and you can see all the details, all the companies, and you can get all this data hands-on also. So that's about it for this video. The last thing that I wanted to show you in this video was how you can calculate the yearly returns that you are getting. Can you do it on yourself? If you can, it's great. So in the questionnaire, in the quiz which is coming up in the future lectures, you can write down and you can put the correct answer. So the question is that you will have to calculate what returns are we getting on this calculation. So I have got my current market price is this, my lowest price and the highest price is this, and the number of years is 5 years. Okay, so what kind of returns will we get? So you will simply have to put the formula of rate, and number of years will be this, PMT will be empty, PV will be negative of this amount, FV will be your future value. So when you do this, you will get one figure. You just have to close it and you'll get one figure as the rate. So just try to calculate this, and I will disclose it in the next lecture what returns are you getting. So similarly you have to do this for the highest price also. So you will get two rates, which will be the rates that the kind of returns you can get on a yearly basis after you invest in the stock at the current price. So if you're satisfied with the returns and the rates that you are getting, you can invest in the stock. If you are not satisfied in the rates and the returns that you're getting, wait for the price of the stock to fall, or either you can jump into a new stock. So that is how analysis is done on Excel, and financials models are made. So this is a very small financial model on how to predict future prices. So that's about it for this video. I hope you guys enjoyed it, and I'll see you in the next lecture. Thank you guys. Stay tuned.